The truth about index funds. Why millionaires love them. When people think about millionaires, they imagine stock-picking geniuses, insider tips, or high-risk bets on startup companies. But the real truth is far less flashy and far more powerful. Many millionaires quietly build wealth using a simple, boring tool, index funds. These funds don't make headlines. They don't promise overnight riches, but they deliver what truly matters: consistent, long-term growth with minimal effort and low fees. In fact, some of the world's most respected investors, including Warren Buffett himself, recommend index funds as the smartest investment choice for everyday people and seasoned millionaires alike. In this video, you'll learn exactly why millionaires love index funds, how they work, what makes them outperform most actively managed portfolios, and how you can use them to build wealth with quiet confidence. 1. What are index funds and how do they work? An index fund is a type of investment that mirrors a specific market index. For example, an S&P 500 index fund invests in the top 500 companies in the US. Instead of trying to beat the market, it simply matches the market's performance. This passive style of investing has major advantages. It removes the guesswork of picking individual stocks. It automatically diversifies your portfolio across hundreds of companies. It keeps fees incredibly low since there's no team of analysts constantly buying and selling. Most index funds are run by algorithms or simple rules, not expensive fund managers. This makes them cost-efficient and more tax-friendly. And when you remove emotions, frequent trading, and human error, your investment is more likely to stay on track. Millionaires understand that the secret to wealth isn't control, it's consistency. Index funds offer a way to invest broadly, cheaply, and effectively without trying to predict the future. Their structure encourages long-term investing by minimizing the temptation to time the market. 2. Why index funds beat most actively managed funds. Many people believe that hiring a fund manager or stock expert will outperform the market, but the data says otherwise. Over 80% of actively managed funds fail to beat the market over the long term, especially after fees are deducted. Here's why. Managers charge high fees, often 1% to 2%, that eat into returns. They frequently buy and sell, generating taxes and transaction costs. Their strategies often underperform simple index tracking. Index funds, in contrast, have expense ratios as low as 0.03%. That means more of your money stays invested and compounds over time. The lower the cost, the greater the compounding advantage becomes over decades of investing. Millionaires don't rely on predictions, they rely on math. Over decades, saving 1% on fees could add tens of thousands of dollars to your portfolio. That's why many wealthy investors prefer passive funds. They're not trying to impress, they're trying to win. Warren Buffett once bet $1 million that an S&P 500 index fund would outperform any actively managed hedge fund over 10 years. He won. That alone says a lot. 3. The power of diversification. Without complexity, diversification is the golden rule of investing. It reduces risk by spreading your money across many assets. But building a well-diversified portfolio yourself, choosing dozens or hundreds of different stocks, can be overwhelming, costly, and time-consuming. Index funds solve this instantly. With just one index fund, like VTI or VOO, you can gain exposure to hundreds or even thousands of companies across sectors. You don't need to research each stock or worry about being wrong. The market evolves automatically, and so does the index. If a company performs poorly and drops out of the index, it's replaced by a stronger one without you having to lift a finger. Millionaires value simplicity and automation. They know that more moving parts mean more room for error. Index funds offer a simple, foolproof way to be diversified without managing 20 different assets. You also reduce emotional decision-making by removing active oversight. It's like owning a small piece of the entire economy and letting that economy grow your wealth. 4. How index funds create long-term wealth. The real power of index funds isn't what happens in 1 year. It's what happens in 10, 20, or 30 years. The S&P 500 has returned an average of 7% to 10% annually over the last century. That means if you invest just $500 per month in an index fund with an 8% return, you'll have over $225,000 in 15 years and more than $1 million in 20 years, 30 years. And this assumes no stock picking, no market timing, and no guesswork. guesswork, just consistent investing and time. Millionaires use index funds because they understand this math. They don't rely on hot tips or high-stress trading. They build wealth the boring way through compound growth and patience. It's not about perfection, it's about participation, letting the market work for you. Every dollar invested in an index fund becomes a building block in a future of financial freedom. It's not sexy, but it works. 5. The role of emotions and why index funds. Protect you, investing is emotional. When markets rise, people feel excited. When they crash, fear kicks in. Most investors buy high and sell low, not because they're stupid, but because emotions cloud judgment. Index funds help prevent this. Because they're passive and long-term by design, they encourage a set-it-and-forget-it approach. You're not watching individual stocks rise and fall. You're not panicking over headlines or trying to time the market. This protects you from emotional mistakes, the kind that cost people thousands or even millions. Millionaires understand that success in investing comes not from brilliance, from discipline and behavior. Index funds act like a shield, insulating you from emotional triggers and keeping your strategy on course. Simplicity becomes a strength when markets are noisy or unpredictable. By investing in broad-based index funds and sticking with them through ups and downs, you avoid the most dangerous part of investing, your own psychology. 6. How to start investing in index funds. Today, starting with index funds is simple, even if you're a complete beginner. Here's what you need to do. Open a brokerage account. Platforms like Vanguard, Fidelity, or Schwab offer access to index funds with no commissions. Choose your fund. For U.S. markets, popular choices are VOO, S&P 500, VTI, Total U.S. Market, VXUS, International Exposure. Set up automatic investments. Even $100 per month makes a difference over time. Stick to your plan. Don't tinker. Don't chase news. Let compounding do its job. Millionaires follow boring routines. They don't try to outperform. They try to stay consistent. Index funds make this easy. With one click, you're invested in the best companies in the world without guessing which ones will win. 7. Why the wealthy keep it simple. Here's the irony. The more money people have, the simpler their strategies often become. Many millionaires, especially self-made ones, choose index funds not because they can't afford better, but because they've tried everything else and realized nothing beats low-cost, broad market investing. They understand that. Time beats timing. Fees matter more than headlines. Simplicity protects against mistakes. That's why some of the richest people you'll never hear about quietly invest in index funds month after month, year after year. They build wealth slowly, safely, and with total clarity. They don't look rich on the outside, but they are free because their money works while they sleep. The most underrated wealth strategy. Index funds are not glamorous. They won't make you look like a genius at dinner parties, but they're the most powerful tool for building wealth that actually lasts. They offer diversification without effort, low fees that protect your returns, automatic adaptation as markets evolve, emotional insulation from panic and hype, simplicity that even beginners can master. If millionaires love index funds, maybe it's time you gave them a serious look too. If you found this video helpful, like, comment below, and hit subscribe. We break down the smartest investing principles in a way anyone can understand. No hype, no nonsense, just clarity and confidence. Because the smartest wealth strategy is often the simplest one.